Get ready for the action, because we are diving straight into the market movements. Alphabet Holdings, LLC has just reported open market sales of Ethos Technologies, Inc. Class A common stock, with Alphabet selling a total of 147,552 shares at prices between $23 and $24 per share. We break down exactly how this transaction affects the holdings of GV 2019, LP, and GV 2021, LP, and what this signals about Alphabet's investment structure right now. And finally, we shift gears completely to macro trends as Stanley Druckenmiller makes some huge moves. Druckenmiller sharply reduced exposure to Amazon and Alphabet while aggressively loading up on commodities, Argentina, and biotech. We'll cover the specifics of his portfolio adjustments, including new positions in YPF and the push into industrial and semiconductor demand, before we wrap up this powerful briefing. Alphabet Inc., a major investor in the technology sector, has executed an open market sale of shares in Ethos Technologies, Inc. The move, reported by Stock Titan, involved the offloading of 147,552 shares of Ethos Technologies, Inc., Class A common stock, which were held indirectly through Alphabet's GV funds. The sales took place over 2 days, May 14th and 15th, with the shares trading at a weighted average price ranging between approximately $23 and $24 per share. The regulatory filing also indicated related pro rata in-kind distributions between Alphabet Holdings LLC and GV 2019, LP, categorized under other transactions and involving no monetary consideration. Following these transactions, the holdings within the GV investment structure have been adjusted. GV 2019, LP is now reported to hold 3,050,697 shares, while GV 2021, LP holds 571,907 shares of Ethos Technologies, Inc. These positions remain classified as indirect holdings linked to Alphabet's overall investment framework. Alphabet is leveraging its upcoming Google I/O Developer Conference as a critical platform to unveil its comprehensive AI roadmap, coinciding with a significant repricing of the company's stock, which has surged approximately 140% over the last year as investors increasingly view Alphabet as a leader across the generative AI stack. The focus of investor attention surrounding the event is sharp and multifaceted, centering on several key areas. The next iteration of the Gemini model, demonstrations of agentic commerce capabilities, details on the in-house Tensor Processing Unit, TPU, chip, advancements in search integrations, and the enterprise positioning of Google Cloud. The opening keynote is scheduled for 10 a.m. PT/1 p.m. ET, with expectations high for substantial announcements regarding AI and proactive agent functionalities. Investors are highlighting Alphabet's vertical integration and speed advantages, with quotes from figures like Lo Tony calling Google the best-positioned company to monetize AI at scale, and Gene Munster emphasizing the speed advantage derived from owning custom silicon and data center capacity. Industry analysis suggests that large platform companies controlling chips, data centers, and models prioritize end-to-end optimizations to reduce latency and cost for AI workloads. For practitioners, this trend signals a shift in focus from pure model retraining toward deployment engineering, systems tuning, and monitoring across the hardware, TPU, model stacks, Gemini, and cloud services. Gemini enhancements are reportedly moving toward more proactive, agentic capabilities, which implies increased emphasis on safety tooling, long context state management, and action authoring interfaces in production environments. Google I/O is therefore being positioned as a pivotal event to validate whether market optimism regarding Alphabet's AI potential is substantiated by tangible product timelines and clear enterprise monetization strategies. While the event will feature consumer-facing demos, observers anticipate a blend of flashy showcases and deep developer-facing details, such as SDKs, latency figures, and service-level agreements, which are crucial indicators for adoption timelines. For machine learning teams and platform engineers, concrete details on infrastructure specifications and clear enterprise deployment paths will dictate procurement decisions regarding on-premise versus cloud execution models. The tech landscape is in flux as major investors diverge on the strategy for Alphabet, Google's parent company, amidst a soaring stock performance. Bill Ackman's Pershing Square recently reduced its stake in Alphabet, framing the move not as a lack of confidence, but as a strategic maneuver to fund a significant $2 billion investment in Microsoft. This contrasts sharply with Berkshire Hathaway, which tripled its ownership of Alphabet during the first quarter, cementing its position as a major shareholder. At the end of March, Berkshire Hathaway's Alphabet holdings exceeded $16.6 billion, making it the firm's seventh-largest holding. Pershing Square, whose Alphabet stake was valued at approximately $99 million at the end of March, concurrently established a substantial new position in Microsoft valued at about $2.1 billion. Alphabet stock has experienced a dramatic surge over the past year, climbing about 140% and 30% year-to-date, driven by the success of its Gemini chatbot, investments in custom AI chips, and its robust cloud computing segment. As of Monday, Alphabet stands as America's second most valuable company, with a market capitalization nearing $5 trillion. However, the broader tech sector, including the Magnificent Seven, is showing signs of divergence. While Alphabet has outperformed, Microsoft has lagged, with its stock down over 12% year-to-date. Bill Ackman attributes Microsoft's underperformance to investor concerns regarding competition from AI lab offerings, such as Anthropic's Claude Cowork, challenging the durability of the M365 productivity suite. Ackman maintains that investors are underestimating the resilience of the M365 franchise, citing its deep integration into enterprise workflows and its foundational security infrastructure. Furthermore, Ackman argues that the market undervalues Microsoft's substantial economic interest in OpenAI, suggesting the current stock multiple does not reflect the potential value of that stake. Ackman views Microsoft's recent restructuring of its OpenAI investment as a strategic pivot toward a multi-model architecture on its Azure cloud platform, which he expects will accelerate cloud growth in the latter half of the year. Billionaire investor Stanley Druckenmiller has significantly rebalanced his investment portfolio, sharply reducing exposure to major technology and consumer internet stocks, while aggressively increasing positions in commodities, Latin America, and the healthcare sector, according to his latest 13F filing. This strategic shift signals a pivot away from the intense debate surrounding AI-driven megacap technology stocks. The repositioning included substantial divestments, notably cutting his direct position in Amazon.com, Inc., by approximately 94% and completely exiting Alphabet, Inc., by selling all holdings. Other positions trimmed included DocuSign, Delta Airlines, DoorDash, and Goldman Sachs Group. Simultaneously, Druckenmiller boosted macro-oriented plays. He reinforced his commodity theme by establishing a fresh stake in the iShares GSCI Commodity ETF. Geographically, The investor focused on Latin America, increasing his stake in YPF Sociedad Anónima by 433% and initiating a new position in the global ex-MSCI Argentina ETF. He maintained significant exposure to Brazil through the iShares MSCI Brazil ETF. While scaling back in pure technology, Druckenmiller maintained a diversified approach to the sector. His chip exposure is now spread across infrastructure, memory, and industrial semiconductor demand, with new positions added to Broadcom, Intel, SD Microelectronics, Micron Technology, and ARM Holdings. Furthermore, the healthcare and biotech bets expanded considerably, with new investments in Caris Life Sciences, Revolution Medicines, and a more than 500% increase in ADMA Biologics Inc. Overall, the filing suggests that the renowned macro investor is looking beyond the current AI narrative for potential market opportunities, favoring tangible assets and emerging markets.